Alan writes, my investment broker has talked with me about a few different mutual funds he wants me to consider purchasing. What are some of the most important factors I should consider when looking at the track record and making an investment?
I like that question.
I figured you would.
There's a lot of thought involved in that question. Let's start with the track record component. And you can go to various sites and or get data from a financial advisor regarding mutual funds and all kinds of analysis and commentary on the fund, as well as detail about who's running the fund and so on. But I think the key component to that question was the phrase track record, because when you look at those funds, the track record is only as good, or is only valid, might be a better way to say it, is only valid for as long as that particular money manager has been on the job.
Sure.
Because a mutual fund might be running over, decades in many instances, and yet the fund manager has maybe only been on the job, the current fund manager has only been on the job for, say, the last 4 years. Well, the argument then becomes that this is a different fund manager, this is a different human being who makes decisions different than his predecessors or her predecessors, and therefore only the last 4 years of the track record are really valid based on who's currently running the fund. The other thing that will also happen is oftentimes funds will absorb each other, or they will merge funds together, or a fund will be purchased and they're essentially buying or merging together the past track record,
right,
which again can have absolutely zero bearing on what the future of that fund is going to look like, because if they've now changed who's managing the fund or who the particular money manager or money management team is, you're now looking at a whole different set of individuals who are making the daily decisions, which is totally unrelated to who previously made the decisions, and therefore the long-term track record becomes essentially nil.
Mike, in the interest of accuracy, I want to point out that that's very true with the vast majority of mutual funds. However, a lot of funds lately have come out that are index funds that are essentially mimicking the index. So there's a little less of that human emotion that's going to be involved in a typical index fund, which I think is worthy of some discussion in a moment. But what else might we want to look at before you're considering an investment in a particular mutual fund?
Well, actually, I heard you, Mark, not long ago, give an absolute top-rate explanation. I'm serious. I'm giving you a compliment. Take that at surface level, will you?
All
right.
I know.
But you did. You gave a top-rate explanation of the average rate of return trap, as we call it. Many of your funds will quote average rates of return, and again, those can be extremely misleading.
Yeah, and I think it's important to understand the difference between average rates of return and a real return or a compound annual growth rate, because I think unfortunately in your eyes you may see those as being synonymous, but they're far from that. Right. So let's just take an example of, if I said to you, what if there was an opportunity that with an investment that has had an 8.6% average annual rate of return over 3 years? You might look at that and say, well, that's pretty darn good.
Because mentally you're thinking 8.6 was year 1, 8.6 was year 2, 8.6 was year 3.
That's exactly right. That's how, when you hear that term, you normally will visualize, well, year 1 was 8.6, year 2 was 8.6, year 3 was 8.6, but average return can be extremely misleading. The widespread assumption is that an investment's average rate of return is the same as its annual growth rate, which is not necessarily true. The biggest challenge to average rate of return is that a simple average doesn't factor in volatility. A volatile market can produce a positive average rate of return while resulting in real losses to the investor. So
that's worth stopping.
Yep.
So you could have a positive average rate of return, but numerically with your real live money, you could have a loss.
That's right.
And a lot of people, that's hard to fathom. Explain what that means.
Well, here's the thing. If you think about how the average person looks at it, the 8.6 average, year 1, year 2, year 3, they think, oh, I'm getting 8.6 in each year. Think about this particular sequence of returns. In year 1, negative 44.7%. In year 2, positive 50.2%. In year 3, positive 20.2%. adding these three returns together equals 25.7%. Divide them by 3 and you get an 8.6% average.
So that's your average.
However, the compound annual growth rate is negative 0.05%.
So you actually came in just below 0% return. You had a negative return, but the average was still 8.6 because you had that huge negative in the first year.
That's exactly
and then
right.
you had a significant positive in the next 2 years.
That's exactly right. And the average person thinks, well, if I put 100,000 in and it's an 8.6, percent return, at the end of 3 years I'm going to have 108 plus another 8,000 plus another 8,000, so I might be somewhere in the 125,000 range. Whereas in the sequence that I just laid out a moment ago, that was a negative, you actually flatline, essentially. Your 100,000 is a touch less than 100,000, so your average compound was certainly not 8%.
My name is Mike Walters, and Mark Mersman has just been explaining the differences between the average rate of return and the compounded annualized real returns that you might see in your own account in terms of dollars and cents. And he's just been explaining that you can literally come in within this example a loss, a negative return in your real account value, even though the average return in this instance was actually 8.6%. And Mark, that's tough to wrap your mind around sometimes. Right. And we had a previous discussion about sequence of returns a number of shows back.
Sure.
And that's really kind of what's coming into the equation here. Explain to us real quickly how the numerics of that actually work.
Well, with a sequence of return, the fact of the matter is when you experience that negative loss in the early going, it takes a whole lot more to recover and to get yourself back to ground zero, so to speak. And that's one of the challenges. And I think from an income distribution planning, which is what our Financial HQ Network advisors work with their retired clients on, is you can't just haphazardly assume, well, 8%, if I average that, I can pull 8% off a year. The sequence of return, is a huge, huge component to understanding a real return and understanding what is ultimately going to end up in your account.
So if you take, say, somebody had $100,000 and they incurred that negative 44.7% you referenced, that would bring them down to $55,300 remaining.
That's right.
Then if they had a 50.2% gain, which was the next number you gave,
which is more than the 44 they lost mentally. I mean, you think about that from a number standpoint.
But now we're applying it on 55,300 is the difference.
That's right.
So therefore, we only get back up to 83,000 and some change. Then if we take that 20%, that 20.2% gain that you mentioned on the 83,000, we're still just shy of our 100,000 starting point. We're at $99,839, and that was real math.
That's exactly right. And that's just simple. Ultimately, you're breaking down, multiplication. And think about this: if you don't think that this can happen, this was the S&P 500 index from February of 2008 to February 2011.
So those numbers you gave, you didn't make those up.
No.
That was the real numbers of the S&P 500, the negative 44.7, then the positive 50.2, and the positive 20.2.
That's exactly right. And I don't I cherry-picked it a little bit.
Well, yeah, proving a point. There's nothing wrong with that.
That's exactly right. The average from February 2008 to February 2011 was theoretically on an average was 8.6%. However, the real compound growth was a touch below zero. To bring this back to Alan's question, the real point is that you have to dive deeper than just looking at, what a mutual fund suggests that its real returns were, and look beyond just what the manager, what their track record is, and understand the fees, understand all of the components that go into it, and ultimately how it fits into your overall financial plan. Because at Financial HQ, we're all about planning first and investing second.